Welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at Money Show, and today I'm pleased to welcome Boris Schlossberg, co-founder of BKForex.com. Boris, welcome to the podcast.
Hi, good to be with you.
Glad you could be here. It's funny. I looked back, and it's been all the way since March 2023 that I've had you on the podcast. So, a couple things have changed since then, I guess, in the currency markets. Start big picture. Where do you see things going with the dollar with currencies right now?
Hard to say because a lot of it is very much contingent on where the Fed goes, right? I think at this point, the consensus view, and I pretty much agree with it, the Fed is certainly done hiking. Although I think the consensus view of the Fed is going to lower rates significantly is probably wrong. It'll take much longer. There'll be much slower decline in U.S. interest rates, which therefore likely going to continue bowing the dollar, continuing supporting the dollar for quite a while. I know all my friends in Twitter sphere seem to be convinced that $160 yen was the top, the blow-off top. That's it. We're not going to see it. I'm not so fully convinced of that yet. These things tend to actually go to even greater extremes before they kind of die out. At this point, the Bank of Japan really has no much options. They can't really raise rates enough. They're at the mercy of the Fed in some ways. The Fed, I think, understands the danger of letting the yen really devalue tremendously. But on the other hand, Japan is an export-driven economy. So yes, even though the intake, all the inputs are more expensive for them, it really makes them that much more competitive on the global plane. So I don't think they're suffering as much as you would think they would be suffering given the exchange rate where it is.
Got it. Well, let's unpack a few of those ideas one by one, starting, I guess, with the Fed. When we talked in early 23, we had just come off this market where it was basically nonstop rally in the dollar, and then this long sideways consolidation. I think for DXY, it was like a peak around, what was it, 113? We're kind of chopping around 105 now. Right. What do you see happening with that? I mean, is this a Fed that realistically could get back into hiking mode? Do you think that's too much of a pendulum swing from when people were pricing in 6-7 cuts at the beginning of the year?
The only way the Fed hikes rates is just the worst case scenario of all. It will only happen if there's a sort of a boycott of U.S. debt. They can't do auctions, or the auctions are kind of really start to fail, or they're not getting enough bid to cover ratios. It's a situation basically where the U.S. debt is not attractive to the rest of the world at the interest rates they are because of concerns of deficit financing and all of the things that people are starting to raise their warnings about. And then you get the worst of both worlds, which is higher rates, slower growth, and just kind of a very, very tense financial situation, which, if that's the case, this, one of the things that people really, I think, are completely unprepared for is if we do have higher rates, deficit financing, all of those things start to sovereign debt kind of a strategy, stocks really get hit very badly.
Yeah.
And that's going to be a negative aspect of it. So, long story short, I don't think we have further rate hikes to go. I think we're done with this hiking cycle. I think the Fed wants to believe they're done with this hiking cycle, and they like to start to slowly but gradually ease ourselves into a nice, steady, soft landing. So far, they've been able to really, really accomplish that. But I saw something really interesting the other day. Somebody posted a very, very unusual analysis of what's really driving consumer demand in the U.S. economy, and I thought it made imminent sense to me. The argument is that, the U.S. consumer is still very healthy because we're getting relatively high wages and because of all the savings that we've had since the pandemic. Those savings have burnt to the ground long, long time ago. And this particular analyst, I forgot his name, was actually making a very intelligent argument that the reason why the U.S. economy is doing well is because of the wealth effect. Because the boomers own the majority of the stocks. They are, 25% wealthier than they were a couple of years ago. That wealth effect allows them to grant lots of money to their children, either, through inheritance or just basically outright subsidy, which is what a lot of parents do with their children, including, me with mine, and, I'm sure everybody else is with theirs. And it's that wealth effect that's really driving the U.S. economy in many, or supporting the U.S. economy in many ways. I thought that was a really interesting analysis. So of course, that's a very vulnerable position because that wealth effect could, 25% decline in the stock market wipes out that wealth effect very, very badly. So I think we should be mindful of all those things.
Okay, let's go back and talk about the yen for a little bit there. I mean, that was kind of the big story. We're pushing up at that 160 level, and then obviously it looks like we had a couple rounds of intervention. Do you think that that's going to be something that the Japanese authorities can kind of hold back the flood, or is this going to be an issue where their interest rate differentials and everything else it makes it a hopeless battle?
That's my argument is it's going to be kind of a hopeless battle, and it's not up to the BOJ, it's up to the Fed. That's really the story. It's kind of very, very tough when you're trying to run defense against your own currency, but you don't have any tools to really control it. And I think the Fed is even mindful of that. So yeah, I don't think that's the reason why nobody really wants to raise rates any further, because that would really be very damaging dollar yen. But I do think we might have another unexpected rally, squeeze rally up there before it's all said and done. Yeah.
One other story that I saw sort of in the currency arena was, I guess it was today or yesterday, the Wall Street Journal talked about China's export boom being turbocharged by them having a currency that I guess on an inflation-adjusted basis is the lowest in about a decade. What are your thoughts there? Is that going to be a source of trade friction? Where do you see the yuan going at this point?
That's a good question. Yes, they are actually, getting sort of, the yuan is getting the same benefit that the yen is in terms of export-driven drive. It's a two-edged sword for them because while it does allow them to have export driving, it also lowers their purchasing power, and they're having essentially, I think, a growth recession, if you want to call it that way, in Japan. In China. So I think there's a limit to how low they want to see the yuan go, and I think they'll do everything in their power to try to support it going forward. Maybe even to the tune of selling their treasury stock to try to see if they can support it a little bit.
I mean, one thing you brought up treasuries, and I'm just kind of curious what your thoughts are on the whole impact, if it's overblown on yen carry trade and what unwind might mean for U.S. treasuries and U.S. interest rates. Is there any opinion on that thing that you see show up in the media from time to time?
That's always a big scare tactic of, everybody's in the yen carry trade and everybody unwinds. That means stocks are going to go down to zero because everybody's financing their stock purchases with a yen carry trade. There's probably, some truth to that, but I think, I think many players are much more sophisticated than that in terms of their positions. And I think at this point, many of the banks and many of the risk managers have gotten a lot more sophisticated in terms of trying to understand how all those moving parts move together. So I don't think that's going to be as simple as, the yen carry unwinds and the whole world, the whole equity world just simply goes down to zero as the terminal, scare story that everybody always likes to use. So I think it will have an impact, but probably far less than most people think.
Okay. Let's shift a little bit and talk about alternate currency, store of value, whatever term you want to use, things that people are interested in, like gold and crypto or Bitcoin here. I mean,
Right.
What do you see going on in those markets really up to this point and for the rest of the year?
So yet another really interesting analysis that I read, which kind of ties everything gold, oil, store of value stories, is the following. For the longest time, for as long as you and I have been around, U.S. has always insisted that oil be priced in dollars, right? I mean, in fact, we could make the argument that the whole U.S. Navy exists for one sole purpose, to enforce that rule. And that's been very, very true. You could make a geopolitical argument that the invasion of Iraq was in many ways, predicated upon the idea that we want to maintain price of oil in dollars, so on and so forth. However, over the last 3 or 4 years, the U.S. has actually realized that it's not in its interest to essentially price oil in dollars continuously. So it's allowed, for example, India to buy oil in rupees or in rubles from Russia. China has been buying yuan denominated oil, and all of that. The reason why the U.S. has decided that that's actually not in their interest is because all those countries, if they had to buy oil in dollars, would have to get rid of their treasury stock, or at least lower their inventories of their treasuries, dumping treasuries at a time when the U.S. Treasury market can't afford any more sales. So it's kind of a release valve. Now, what's interesting, the side component of that is if you sort of start buying oil in other currencies, right? The neutral store of value actually becomes gold for central banks, for grown-up people, not for little kids who play Bitcoin, becomes gold, right? And as gold has sort of become kind of like this neutral settlement currency, you see, I mean, I trade gold every day. It is literally the greatest market to trade long I've been in ever since I can remember. I mean, it is just the greatest short-term scalp on the long side, long-term positioning scalp, whatever you want it. And because it seems to be like this perpetual bid. Every time it goes down, there are buyers in gold market. Now, of course, there's speculative buyers, there's lots of, short-term buyers, but I kind of feel that maybe that thesis is right, that there is a central bank bid in gold. And, you see gold 23, you see gold 24. It's not at all impossible for us to imagine gold 3,000 sometime, down in 2025. Not because of, sovereign debt issues, all of those other things, but this whole peripheral issue that gold and oil are kind of tied at the hip because of all these geopolitical issues there's an interesting thesis, and it made a lot of sense to me.
All right, sounds good. Any thoughts, I guess, on equity markets? Because we're sort of making our way around the major capital markets here. I mean, I think on Twitter you mentioned something about maybe some issues as we get further into the summer. People might find some volatility at that point.
Yes. So that's another interesting study that I came across. Sell in May and go away. We all know that. You and I have been in the markets forever. We've heard that statement every year, and generally that's actually true. The May to October segment, those 5 months, right? That is statistically since 1950 has been the lowest performing 5-month segment of all the other months. So generally that principle is true, but when you look underneath it, what's really, really true is that it's the September and sometimes October that really destroy that whole segment. It's not so much May and June and July where things get really dicey. It's much more at the end of that cycle. In August and September tend to really drag that whole period down. So I guess the point being is that, I've been bearish the market for the last couple of weeks, and I've been wrong. I mean, the market continues to creep higher, so you have to respect this move. But I do think we might see some turbulence going forward. I mean, if you look at it sort of just from a purely fundamental point of view, clearly jobs are starting to slow down, right? We still have relatively sticky inflation, so there isn't going to be much monetary support out of the Fed. The situation in the Middle East continues to just be, 1 inch away from blowing up. There's just a lot of unknowns, going into the next couple of months that makes me think that generally investors, go away in the summertime. Like there isn't this fervor to want to get into the market in June, July when everybody's on vacation. So I've seen weirder things, but all things being equal, you kind of have to say it's probably going to be a pause to a slow, maybe steady drip to the downside as we get into the late summer.
I guess if you try and look beyond that towards the end of the year, I mean, are you still fairly bullish on how we finish the year out, or are you still concerned all the way through year end?
The problem is that this is election year, so you might, it's a lottery. It's a complete lot. It's a spin of the roulette wheel. We have no idea what happens, much less how it happens. I mean, God knows we have 2 chaos agents running for president, and if there's anything you can just be certain about is that nothing is going to be quite exactly as you thought it would be under normal circumstances. So my point is, it's just it's all going to be very much unknown until we get the election out of the way, and then I think whatever the resolution is, then you probably have a concerted move one way or the other out of the market, because at that point, at least investors will have some confidence in forward guidance.
Got it. Well, in the couple of minutes we have left here, I mean, obviously we're talking because you're going to be joining us for the Money Show Masters Symposium in Vegas in August. And you got a new topic you're talking about there. It's prop trading and, talking about whether it's the best way to trade the market in 24. Can you expand on that a little bit?
Yes. So this is a brand new, it's relatively new. It's a couple of years in the making trend that's happened in the retail market, but it is literally the most popular, the fastest trend in retail market I've ever seen in my life. Literally millions of people have now gotten into prop retail trading, and it's brand new that most people really aren't even aware of it. It's basically lots and lots of companies now that allow you to essentially trade on demo accounts, take evaluation tests.
Okay.
And if you pass their exam, which is like you have to make a certain amount of money without losing a certain amount of money, sometimes within a given a period of time, a lot of times now without any kind of time constraints whatsoever, they will then fund you with a certain amount of capital, and you get to trade their capital. And if you succeed in the same way as you succeeded on your test, then you're able to extract money that is not yours. That is, the prop firm's money. Now, as with all competitive things, very few people are actually able to succeed in this. But there's huge benefits in this, even aside from just those that are succeeding. Now, one of the things that we started to do is we created something called, prop trading academy within my service, where we actually teach people how to help pass these tests. And one of the most satisfying things in my life as a kind of a professional educator and a trader has been how many of my students over the last couple of months have been able to pass these tests, which are very hard. I come from a very, it's funny. I was always a very, very good student. I was one of those goody two shoes who was always a straight A student. So I kind of took to this. I literally take it exactly like I did when I was in college and high school. This is a test. I'm going to study this test. And I'm going to succeed in this test. And then I said, you know what? I think I can teach the same skills to other people. And I did. And I'm very, very happy to see so many people pass these tests. And some of them are now already well beyond that. They're getting actually funded, and they're actually collecting money because they've been able to make money on the funded tests. And so that's great. It's been personally the single most satisfying aspect of my career to see so many people do well. But aside from that, I'm actually an ardent believer that this is an amazingly great tool for somebody who doesn't even ever get funded. It is the equivalent of teaching a pilot of how to fly in a simulator. It literally is. There is something completely different when you're, most people trade on a demo account and they just blow them all up because it's their own. There's nothing at stake. But once you make something at stake, you actually begin to practice really, really good trading techniques, good discipline, really accountability. And all those skills are then transferable to your own trading. And I think it makes you generally a much better trader, even if you never trade prop money in your life. I just think there's an enormous amount of side benefits. I'm going to be talking about what it is, what type of prop firms there are, what you can trade, which is literally everything under the sun at this point, and so what are the best ways to kind of succeed in trying to, if you want to give this a shot, and why everybody should do it, even if they don't really want prop trading, why they should try and do it, because it's such a good experience for everybody.
Well, Boris, I appreciate you going into a little bit of detail there. I know people are going to be excited to hear what you have to say in Las Vegas. If you're watching this, guys, again, Boris is going to be joining us at the MoneyShow MoneyMasters Symposium. It's going to be running from August 1st to 3rd at the Paris, Las Vegas. You can get more details in the link below. Again, Boris, thank you so much for your time today, and we'll see you in August.
Thank you. I'm looking forward to it.